We're recording now.
All right, well, welcome everybody. I was on with Mr. Becker a few minutes ago, and at 3 minutes after 4, there were only 30 students out there. I said, well, they're going to do their usual just-in-time arrival, and it looks like most everybody has turned up. Of course, I'll verify that with the Zoom roll later tonight. But welcome everybody. Seems like it's been a while since we've done a ring speaker. We're once again in this Zoom format, as opposed to being together in Huff 150. But our speaker today is Dr. Bill Hughes. Some of you have met Dr. Hughes. He joined us, I believe July 1 was his first day. I actually knew Bill when he was well, in another life. I knew him when he was assistant professor at Louisiana State University. But I believe about 25 years ago, he transitioned to the dark side. That's what academics say when an academic transitions to the industry side, moving to the dark side. But he's been on the dark side for 25 years. I'm going to let him tell you his story, but he's spent the last decade or more as the chief real estate researcher for UBS. So I wanted all of you to get a chance to get to know him a little better. So I asked him to come on as a ring speaker and share some of what he knows about the industry with us. So Dr. Hughes, the students are all yours.
All right, I'll go from here. So before I get started, let me just confirm, since we're doing this over video, does the sound come through okay? Is that all working?
Yeah.
Okay, good, thank you. Okay, great. So when Professor Ling asked me about this, my first response was, sure, I'd be happy to do that. And then when I stepped back from it, I realized that I'm really a person in between here. So I'd rather be there in person and talking to the class. We'll do it this way. And I will try to give some background on the professional side, even though I've just left that and I don't have access to it anymore. So let me just start. Hopefully everybody can see my screen. If not, then somebody please shout out. And I'll start by giving you just a little bit of background. The first bit of that is that I am between two stations here. I've just left the professional side, and therefore I don't have access to any of the interesting ideas or projects or anything that I would have had 6 months ago. And I'm just getting started here. So I don't have a lot of fascinating things sort of completed, but we will have some interesting things coming soon. Then I started to think about this, and it won't be clear that I've prepared for this, but I have. And I thought I would make a reference to Deep Thoughts by Jack Handey, which was an old Saturday Night Live skit or bit. And I realized nobody on this call would know who that is or anything about it. So I encourage you to Google Deep Thoughts Saturday Night Live, and hopefully you'll find it as interesting as I did. I found them hilarious, or maybe it was just late at night when I saw them. And then one thing that I would like to just set up front is that through my comments today, I will probably speak with some sarcasm, and I will probably be critical of things that I think were ridiculous and crazy behavior that I witnessed. But I do want to be clear. I've really enjoyed this profession. The real estate investment industry is a fascinating one, and you can never fully understand it, and that's what makes it so interesting. Every project is different, and we have the advantage over all other investors in that we can go and touch and see the stuff that we're working with. It's not just a piece of paper in a directory someplace. So even though I may be sarcastic and critical, please be aware this is a great industry and a great profession. I've really enjoyed it. So some things that you might be able to expect through this discussion, I hope to give you some insight as to what some of the different roles are. We talk about real estate, and it's a wide open field. There are a lot of things you can do. So I'll try to define a few of those. I won't get them all, but at least some of the key ones. I will let you in on what you need to do to be hired and promoted. That will be buried in here, so you'll have to pay attention to see when that comes out. And I will tell you things that other people won't tell you. Mr. Becker and I have debated this a little bit, and he's encouraged me and said, "Oh, it's all fine." So we'll see how much trouble I get in. But if you're expecting this to be a cheerleading session about how well this all works and how true and good everybody is, this is the wrong place. I'm going to tell you all the bullet wounds that I received, all the traps I stepped in, and the craziness I've seen, and I'll just be wide open. I owe you 3 apologies before we get started, and then I won't make any more apologies as we get going. Number one, I received some good advice a couple of days ago about how to treat this. And I was told that it would be a good idea if I offered a project and had people analyze it, and then they could give some feedback, and then I could give some response as to how it worked. And that was very good advice. Unfortunately, I had poor execution. I couldn't figure out a way to do that very quickly. And given that this is a speaker series, I thought it might be okay to speak. But I do promise that I'm going to heed that advice in future events. So as things go on, I'm going to listen to that and be better at it. But this will be a boring speech. I apologize. Number 2, I will violate all of my principles when it comes to a presentation. In the fact, I'm going to have a PowerPoint that's full of text. And generally, when I would give presentations in the past, I would have PowerPoints. There would be no text at all. It'd be charts, graphs, pictures, etc. And then I would give the description. But like I said, I don't have the equipment I used to have, so there'll be a lot of text in this, and hopefully you'll just put up with me. And then third, I will use bad analogies. So I'm not a pun master. I've worked with several people who are very good at puns, and so every time you say something, they'll come back with some quip, and quite frankly, it just drives me crazy. So I'm not good at that. I'm not that smart. But I am guilty of using a lot of analogies. I like to compare things to things I think are more easy to understand. And there's a key one I'll start off with pretty early. And then finally, there's no theme for this talk. I don't have any clever package that I can put this in. So I'm going to start off with my first bad analogy and tell you how I'm thinking about this presentation. And I'm thinking about it like a charm bracelet. And if you think about what you're doing in class, the things that you're learning here in the classroom, that's the bracelet. You have to have the bracelet so that you have something to put the things you learn on. And so if you think of the fundamental information you get in class, how to use different information, how to put them together to get an output, that's going to be the bracelet. What I'm going to do is dump a bunch of charms on the table, and you can decide which of those charms you want to pick up and put on the bracelet, and which of those charms you just want to dust off onto the floor. So there's my first bad analogy. We're off to a running start. One last thing I'll say in the setup here, and that is, I like Winston Wolfe, I talk really fast, so try to keep up. But I will take a few breaths here and there, and jump in and stop me at any point in time. If anybody just says, "Stop, Bill," I'll stop. I would like to get any questions or thoughts. You can tell me I'm wrong. My skin is very thick. So I'd be happy to hear any input that you'd have. And I haven't set this up to request it of you, but please feel free to chime in. So we'll start. This is my attempt at trying to put together the timeline of my career. And I've already given you the warning that I don't have people helping me with good graphics. So what I have here is sort of the term I've had. This is academic time, as Professor Ling described. I started out in school and then became an academic. That's where I became interested in real estate. I didn't start out thinking about real estate, but my life has really been a series of just choosing the fork in the road and then charging down that road as hard as I can. And now I'm at the point where I'm going back to the academic side, and I'm looking forward to doing that long into the future. But this is the 25 years that Professor Ling described. I started with a small advisory firm in '95 and had a series of changes. It looks like I was unable to hold on to a job, but it's not quite as gruesome as it looks, in that the things in brackets are really the same job. So I had basically 3 jobs It's just they kept changing on me, or we kept selling the business. So I will use this as a guide and march through the things that I've done, and hopefully try to tell you the traps that I've stepped in, and you'll step in them too, but at least you'll be aware of it once you do. I don't know how to tell you how to avoid them.
Mr. Hughes,
Yes.
did you work with Chuck Davis?
I don't know Trep Davis. Where was he?
He was with MetLife.
With
That's
Met.
Chuck
Oh, yeah,
Davis.
yeah.
Chuck
So-
Davis. Yeah.
Yeah, Chuck Davis.
Yeah. So here's a. Thank you, Jacob. I appreciate that comment, because that's a good start. Many of the firms that you end up going into are very vast, and so MetLife is a tremendously large group. I worked with a small company called SSR within that, so it was a big real estate function, but it was small relative to the MetLife world. And so I can probably list off maybe 50 people at MetLife that I know out of the thousands and thousands that are there. But that's a good point. And I've been asked that about UBS as well. People will say, "Oh, I know somebody at UBS," and I'll say, "There's 60,000 people there. I don't know them."
So was SSR a subsidiary?
It was.
Okay.
Yes, and it no longer exists. It was sold to BlackRock,
Okay.
and that was an interesting step along the way. I've experienced that twice now. So thank you for interrupting. I appreciate it. Let me start with the first charm. So the first charm that you can choose to put on your bracelet or not is to know yourself. And that sounds really simple, but let me give you a little bit background to that. And that is, you don't have to be honest all the time, but you have to be honest to yourself. Otherwise, you might get in a role that is not suited for you, or one in which you won't be happy. So at least with yourself, be honest. And then the second part, and this is the part that people generally won't tell you, is you will have to determine what you can do and what you are willing to do. And that is, if you can do things in a very analytical way, and you tend to think in terms of numbers, then there are whole sorts of activities in the real estate world that will suit you very well. And you'll be good at it. You probably won't be so good at the parts that involve a lot of engagement with a lot of people, and you're having to entertain and do those kinds of things. That may not suit you so well. And so you have to decide what you can and can't do. But equally as importantly is you have to decide what you will and will not do. And there's a long list of these things where this will come up, but I'll pick one. And that is, you have to decide when you will and when you will not lie. I promise you, you will lie. So if I can put that in context, if you're talking to a 4-year-old child, you probably are not going to go to them and say, "There is no Santa Claus," right? You're not going to do that. You will imply there is one. You've just told a lie. So now you have to decide where that line is for you. And it's very different for for every different individual. So decide what you will and won't do. That also will guide you into your role, and it also will determine the part you play in the whole real estate function. So again, be honest with yourself, know what you're willing to do, and that will help you pick the job that works for you very well. Okay, nobody's passed out yet. Let me just touch on a few of the jobs. So the jobs that I've come in contact with are pretty varied. And so knowing what you can do and what you will do will help you pick from among these jobs. And there are other jobs in real estate that I haven't chosen. I've really chosen the things that are involved in real estate investment, but there are other fields in real estate as well. And so if I just go down and pick a few of these, I would suggest that I have heard most of you, sorry, I've lost my little pointer here, but I've heard most of you say that you would like to go into development or transactions. That's a very common thing that I've heard in your 2-minute introductions and what little I know. People like these two fields. So first of all, development is a lot thinner than you think. There are fewer people involved in development than many of the other fields. It's a pretty tight field, and it has its own special conditions. So it's a great area, but it takes a certain type of person to be able to do that. And transactions is a pretty big role. But in terms of knowing yourself, if you have a thin skin or you are offended by bad language, do not go into transactions. This is a pretty aggressive area, and people will accuse you of things and be nasty and talk like sailors. That is the nature of transactions. The hard thing is to do that when you're debating with the other side, and then turn around and behave very calmly when you go into the boardroom of your peers and try to present what you're doing. So the people who can transition from harsh to really nice, those people do well there. This is also a very analytical area. So if you're analytically minded, then transactions is a good area to go. Of course, I believe research and strategy is the premier type of role you can have in any function, but I can tell you there's a lot of frustration that comes with that. So if you're in that area, you have to be able to deal with a lot of frustration, because many times you will walk up and say, I have a lot of information that indicates we should do this. And somebody will say, thank you, we're not doing that. And you just have to be able to go back to the drawing board and start again. So that's another area. I've heard nobody mention this term since I've been here. Nobody has mentioned being in portfolio management. And I would say when you get into an investment environment, that is like the premier spot. Most people like to get into portfolio management because it's the place where you get to act like the owner, but you get to work with projects that are so much bigger than you could have as an owner. Effectively, you are the owner's advocate within the firm. And therefore, if something needs to be done at the property, we need to spend capital, we need to divest of a property, or we need to put another property into a portfolio. All of that is decided by the portfolio management team. And the places where I have worked, these are the people for whom all of the rest of us work. So we're all trying to help the portfolio managers make the best decisions. They're the ones who have to pull it all together. There are a lot of roles within portfolio management, but nobody has mentioned that, and you might want to give it some consideration. There are also a lot of roles within the real estate function that are critical, that will be very focused in the real estate area, but they won't really be part of the direct firm. We have all kinds of legal requirements, and obviously some of you are joint JD and MSRE. You're well poised for this and going perfectly into it. You don't have to be a lawyer to work in this area. There are non-lawyers that work in compliance and also in fund formation, but there are just a lot of legal components to transferring property. It's a critical part of what we do. Accounting is pretty specialized, so that's something where generally you would take a generalist and come into that, but there are some areas where a real estate oriented person might become involved in. So specifically, if you're doing performance reporting or something of that nature, you don't necessarily have to be an accountant, you just have to understand the language. And obviously there are a lot of people who do finance related jobs. There's a lot of borrowing and lending in real estate. In fact, as we go through this, I will tell you, my belief is there's too much borrowing and lending in the field, but that's part of what makes it fascinating. And then another area where these two areas down here, I would say are important areas. Consulting, there are a lot of things that you can do in that area. Effectively, you're trying to help an owner or a staff member make decisions about what to choose. And then brokerage, they're trying to bring the deal together. So I'll also comment here, I have tremendous respect for brokers. They have to know a lot of information. I can tell you as a buyer's rep, I generally believe what the broker is telling me, but I don't expect them to tell me everything. So again, they'll pick and choose the information that I get. So I'm very cautious. And at some point you might hear me use the term broker data. Again, that's a little sarcasm, but it doesn't mean I don't have respect for that. It's a pretty challenging area, but this is probably the area where you can make the most money. So if you're interested in money, that's a pretty good place to get started. And then the last thing, I'll go back up here to business development. Business development is generally not very analytical, but personal relationship skills are very important. So in this case, you're either trying to market your firm to the clients out there, or you have clients with whom you're working and you build a relationship with them. so that you can inform them of how the business is working. And this too requires sort of a specialized individual, but a very, very interesting one. So any questions about the different fields you can go into?
Yes, Dr. Hughes, same here. Is it possible to provide us maybe at a later date some of the companies that align with this different, I guess, these different categories with the job search? For instance, if you mention asset management, I know we have some of the data in the advisory board database, but if you can help us with some companies, that would be appreciated as well.
Yes, I'd be happy to help identify those. I have to admit, at the moment, I don't have sort of a list together, but I bet if we get together and think about it, I think that I can help identify. First of all of these functions are involved in just about every advisory business or every type of function. And then there are other businesses that very much specialize on this. So for instance, we had 4 valuation specialists within our organization who helped us determine the value of the properties, and they had the specific job of working with the third-party valuation group or third-party appraisals. And so there were independent companies that focus exclusively on that, and they're very big ones. At the moment, I can think of there's Real Estate Research Corporation, RERC, and there's another group called Altus, which is a Canadian organization that spun out of Price Waterhouse. These are organizations that focus very much on the valuation process. They have all kinds of management of that, and they have their own appraisers. So I'd be happy to talk about some of those and help people identify them. That would be easy to do. So now I will tell you 2 things that I wish I had known early on in my career, and I didn't learn them until later. And again, I'm not giving you the cheerleader version of this. I'm giving you the sort of the reality as I see it. And this is just my individual path. First of all, people don't remember what you say. And this cost me a tremendous amount of time because I didn't know it. And when I first moved from academics to the dark side, and I joined the firm at MIG, I felt it critically important that anything I said today, I have to be able to back up tomorrow. And I don't ever want to mention a single word that somebody can pick me apart on, because that was my training as an academic. As an academic, you go in and present. And I had a unique situation as an academic. So I said I wasn't going to talk about academics, but I'll give you one comment, which will tell you where I start. My major professor was a man named Jim Kaw. And he is notorious in the industry as just being a mean guy, or at least he was when I was a student. It's changed now, which is frustrating because I paid the price. But he told us one time that if you're in the audience, your job is to make the person presenting look as foolish as possible. And if they cry, it's a bonus. So that's my background. That's where I started. And therefore, it was very important to me to make sure that I didn't say things that people could come back and criticize later. And so I spent enormous amounts of time trying to make sure that all my statements were very straight and clear, and I didn't sort of superficially say something. And that cost me way too much time. I should have just sort of gotten a general idea and said what I needed to and moved on. So that cost me. So keep in mind, you can make mistakes and you can say things that are wrong. And if somebody happens to remember it, then just say, yes, you're right. I was wrong then, but I know better now. That all works, and move on. You're not scarred for life. The other thing that I learned, and I didn't learn this until much, much later, and that is experience is as valuable as success. So let me describe an individual to you that has a lot of success. There's somebody who works in a large advisory firm, and they have a very important role. They're a portfolio manager, and they're investing $1 billion every few years, and they manage a large portfolio. And so they're doing a lot of transactions. They're underwriting a lot of deals. And then it turns out that they make several bad choices, and they lose hundreds of millions of dollars for their client. They lose a tremendous amount of money. Generally, after about a year or two, that person is known as experienced. and they'll get another job doing that again. And that person then can go on to start a new role and maybe even start their own firm and run a very, very large, successful real estate investment business after they've had a period where they've lost hundreds of millions of dollars for their client. Now, I would tell you that I'm not going to tell you who that person is, but rather I'm going to tell you I can't tell you who that person is because that represents a lot of people out there. There are many people who at one point in their career had a disastrous result. They probably were fired and they went around, they got back into the business and people talk about them, that person is an investor. Well, they may not be a successful one, but they're an investor and they do learn things. So experience is a very important component. And I don't want to encourage you to go out and take ridiculous risks. I'm not trying to push you that way, but too many people will focus on accuracy and things of that nature. Get the experience. Don't be afraid to go out and take some risks. Just make sure they're calculated, and I'll talk about risk later. But experience is an important component in this business, notwithstanding your level of knowledge. This is just a fun one that I learned when I was at MIG, and that is, don't try to impress people with big words. Tell them what you really are thinking. And I've seen this several times, but there's one that I remember from many years ago just because it was great. We had an acquisitions officer who was presenting a apartment property to us. And in this, we all knew it was in kind of a tough neighborhood, and we were worried about whether there would be crime or vandalism or something like that. And in the presentation, the acquisitions officer said, look, we're well aware of the situation here, and I want everybody to know that we're going to securitize this property. And a few of us looked at each other and we thought, we're going to sell securities backed on this asset? We're not in the securities business. We've never done that. And so somebody said, what do you mean we're going to securitize this property? And he said, we're going to put a fence around it. So if you mean you're going to put a fence around it, say you're going to put a fence around it. You don't need to say securitize or anything crazy like that. More often than not, you'll trip yourself up trying to use a word that doesn't fit. So it's just a little quick lesson there. Say what you mean. Nobody needs the big language. When I was at UBS, I also worked with a guy who it was critical to him to demonstrate that he was the smartest guy in the room all the time. It's to your advantage to let the other person think they're the smartest guy in the room. So take advantage of that. Don't try to use words nobody else knows. I promise you, this guy, when I entered the business, this guy was using words like multicollinearity and heteroskedasticity. These are things he learned when he was in school. It did not apply to anything we were doing. And once somebody else walked into the room who knew what those words meant, it sort of deflated the whole thing. So don't use words that just try to impress people. So now the next thing I'd like to go into is to let you know that I believe there is a great comparison between gambling and investing. And oftentimes I will use analogies about gambling that will help me understand or help others understand something about investing. But I want to be very, very clear. I'm not suggesting that investing is gambling. They're distinctly different. The reason I like this is that the gambling world is incredibly precise and the probabilities are very specific, and they've worked out very interesting things like the results of repeat events. And we can learn a lot as investors by looking at that area and understanding it better. So I will make analogies over time. I'll make one in a minute. But there's a very big distinction between the two. And that is, if you're gambling over time, you should expect to lose. And if you're investing over time, you should expect to win. And that's a pretty big distinction between the two. However, many of the activities are very, very related. In all cases, you're putting something at risk and you're taking an uncertain outcome. And the more you understand about how that works, the better you can understand the outcome, but you will never know for sure what the outcome is until it occurs. In fact, that may be a future thing I'll bring out here. But let me just take a breath. I don't see any questions, so I'll just plow on. So let me give you, I used to use this example to tell people that this is the value of research, but I'm really going to just use it as an example of what you can and cannot know, and when you should be prepared to make a decision and what you should expect when that happens. So I have two virtual bags of marbles here. I just happened to label one New York and one Phoenix because that tends to get people's minds thinking. But what I'm going to say is we're going to have a game, and the game is you reach into the bag of your choice and pull out a marble. And if the marble is blue, then you receive the payout. And if it's red, you lose your investment. So it's a pretty simple, straightforward game. And if I were to ask you now, from which bag would you like to choose? You might pick one because you like one better than the other. You might say, well, I like sunny Phoenix, so I'll go with Phoenix because that's a fast growing place. Or you might say, I'll pick New York because it's really big and liquid and everything's safe in New York. But you don't really know anything. You're just saying, I'll pick one. So right now, your odds are the same before you go in. If you do work and analyze this, you might see a picture that looks more like this. Now, if you were to think that every one of these marbles represents 10,000 marbles or something of that nature, just to make it a little more daunting, but you might do some analysis in the area and you might conclude that this is what the picture looks like. I have a little insight as to what might happen here. And without forcing you to count, I will tell you there's an even number of blue and red marbles in this bag, and there are more marbles in this bag than this one. There are fewer marbles here to choose from, and there's basically one more blue marble than what's even in this bag. So now if I were to ask, which bag would you like to draw from? You should not answer me too quickly because I haven't told you the price or the payoff. Right? It so happens that the price to play these games is usually different and the payoffs may be different. So you have to know a lot of components before you make the choice, but let me make it really simple. It's $1 to play. If you pull out a blue marble, you get $2. If you pull out a red marble, then you lose your $1. In that case, which bag would you want to choose from? New York or Phoenix?
Phoenix.
Thank you. Thank you. I would probably choose Phoenix because I have a higher probability of getting a blue marble. Now, if I am giving that information to my investment professional and I'm saying, I think you should draw from Phoenix, and they say, okay, I'll listen to you and I'll go draw one from Phoenix, will they draw a blue marble? This is a harder question. This is a harder question than which bag do you want to draw from. Will they draw a blue marble?
Hopefully.
Perfect. Those are both great answers. Thank you. Hopefully, and we don't know. All we know is they have a 57% chance of drawing a blue marble and a 43% chance of drawing a red marble. So when they reach in the bag and they pull a red marble, what do they think? All right.
You're a bad advisor.
That's right. They think Bill's an idiot. He told me the wrong place to go. And so that leads me to the next charm that we come to. By the way, I'm not calling these pearls of wisdom because they're not that wise, but they're just things to think about. And that is, you will find that there are good decisions with bad outcomes. That's what we just described. And there are bad decisions with good outcomes. And the vast majority of things we repeat are the latter. It's very, very common in any investment world, real estate or any other, that people will make bad decisions, they will have good outcomes, and then they will repeat that bad decision. Now, the one thing we know from the gambling example is that if they repeat that long enough, they will ultimately lose. But you only have so many times that you will do things, and it's very important in my mind, at least it's important to me, it's not important to a lot of people, but in my mind, it's important to distinguish whether somebody made a good decision and just had a bad outcome, or whether they made a bad decision and had a good outcome. So I'll give another gambling example to this. So we're playing blackjack in this example, and these are our cards, and this is the dealer's cards, right? Denoted by the D. I don't know whose hands those are, but that's unimportant. So now we've been dealt 2 9s, and the dealer has a 7 showing. You don't have to know this. I will just tell you that if you have no other information, you definitely do not want to split the 9s. If there's no other information, you keep the 2 9s. That is the best choice. However, let's say that somebody chooses to split the nines, and after they split the nines, they get a 10 on each of the two nines, and the dealer turns up a 10. In that case, the player here made exactly the wrong decision, and they won double their original bet. So they got a really good outcome. So if that happens, chances are that person is going to split nines in the future more often. And that is not the right play here. Let's say you do the opposite. Let's say you're looking at this and you say, oh, I know I'm not going to split the nines. I'm going to keep the two nines. The dealer turns up a 4 and then draws a 10. They get a blackjack, you lose. You've made the right choice. You had a bad outcome. You have to be able to roll with that. It happens all the time. So you have to be able to be confident in your mind, we made the right choice. And we would do it again if that came up. So the only thing that might change your mind here would be if you had additional information. So if you're a card counter and you happen to know that the deck is particularly 10 rich, in that case, the right decision now changes and you would split the nines. Again, it doesn't mean you'll win the hand, but it means your decision has changed. So sometimes the information you have will help you make a different decision, but you will oftentimes be put in a position where you have to make a decision with less than perfect information. That's a big difference between the academic environment and the professional environment. In academics, you pretty much get the information you need. You have to learn how to put it together to get the right solution. And there has to be a right solution. Otherwise, people can't determine whether you've done it correctly or not. In the professional world, there's limited data. You have to make decisions, and you may make the right decision and get the wrong outcome. And if that happens, have the conviction to do it again. So this is a very important one. I guess that's why I put it on an orange background. I don't know why I did, but risk is the most important factor. If you haven't already heard that in your classroom discussions, you will. You'll have a lot of discussion about risk. You will believe by the time you leave here that risk is what drives your decision-making. Understanding risk is critically important. When you leave here, risk will all be but ignored. Everybody will talk about risk. Everybody will pretend like they're using it, but it will be pushed aside because it's very, very difficult to measure. It is difficult to understand the level of risk that is being taken, and most people don't have the knowledge to be able to put it in the right context, and that means they're very susceptible to people selling them high risk. So it's important to be aware that risk is critical. The more you understand about risk, the better informed you will be, and the better the decisions you'll make. The more times you'll make good decisions, regardless of the outcome. Just keep making them. They're a very important thing. The other thing that generally happens is consultants usually focus on outcomes because they can measure the outcome. They don't focus on whether you took low risk or made a good decision because those things are really hard to measure. And so understanding that and knowing the weakness in it, I think will be something that you might be able to use as you go through, hopefully what will be a long career for you in this area. So now let me move from one piece to another, and I'm making a short move this time. I'm going to move from MIG to Associated Estates, which I was fortunate enough to become partners here. This is a great company. I really loved it. And then we sold that business to Associated Estates, and that was a very expensive lesson for me. This is where I learned how much of an academic I still was. To this day, I remember sitting at a dinner table when we were making a decision about which of two companies to sell our business. And I was obviously the most academic in the room. Everybody else was much more professional than I was. And at that dinner, I made 2 points. I said, Associated Estates or AEC is the least sophisticated of the two options we have. We can have the biggest impact on them. So I think joining them, we will have a big impact. And 2, they're a publicly traded company, therefore they're probably priced fairly. And therefore we can go in, when we make our big impact, the market will recognize that and our value will go up. So that's the decision we made. We didn't really make it because of me. We made it because there was a place for our president to have a job. But nevertheless, I just go by my own thought process here. So we made the decision to merge with AEC, and it was actually a sale, but they called it a merger. And at the public announcement where they announced that they were merging with MIG, they also announced that they were restating their financials. So what that means is that all of the information we used and the market used to value them was incorrect. They were restating. And that was information that we did not have. So that was a pretty good lesson for me as to how things might change. And it leads me, and I've had many other instances where this came up. Why am I getting stuck here? There we go. And so this leads me to the next thing that we should keep in mind, and that is, despite the average, every project is unique. And for project, you can substitute every boss is unique, every company is unique, every client is unique, every tenant is unique. We do many, many things based on the aggregate or the average result, but that average is made up of a lot of individuals. So don't make the mistake of thinking each individual is like the average. It's important to know if I make a random draw, then on average, that's going to be my result. But if I'm looking at an individual within the population, I should try to collect more information so I know more about the individual, not just the average. Okay, so knowing the average is important, but that doesn't tell you much about every component of what makes up the average. So this is something else that I learned when I moved to the private side, and it's a bit of a controversy. In fact, there may be disagreement in this virtual room here. I think public REITs are an important form of investment. They're important for portfolio managers and a critical tool for us to use. I do not think they are real estate. I think REITs are companies. They happen to be companies that focus on real estate. And there are many fantastic real estate jobs at publicly traded REITs. I would encourage anybody to work for one if they get the opportunity. Not the one I chose, but pick a good one. They should definitely, you should all be encouraged to consider working for a public REIT. They do real estate jobs. In my opinion, their returns are not that of real estate. Their performance is not that of real estate. And let me give you one little example as to why I think they're slightly different. So on the left side here, I have my personal description of a property or a private real estate fund. And if you invest in this, then what you're going to get is the income, which is rent minus expenses, and you will receive the appreciation or the growth in the value of that property. And in order to get that, you will pay fees to people to operate that for you or make the investment decision for you. This is the package you buy when you invest in property or when you invest in a private fund. This is the package you buy when you buy a publicly traded REIT. Similar to this, you will have a bunch of properties for which you are earning the income, rent minus expenses, and the increase in the values you will get as appreciation. You will also be buying the management. You will be paying for that and receiving the benefits of having management. Chances are there will be a development component, which can be any size. It could be very small like I've drawn it, or it could be a tremendous portion of the REIT as I've drawn it. And you have this other little component that you're going to pay for up here, which is the expected growth of that firm. So in the corporate world or the stock traded world, trades are made based on people's expectation that that firm will grow. So if a REIT were to buy property and say, here's my portfolio, I don't intend to expand it, I'm just going to manage this portfolio, that REIT would have a terrible value because that particular pool of investors invests in growth. And if you think about anything you've learned in finance, everybody wants to know about the dividend growth. That's what they want to buy. They don't want to buy the steady dividend. There's a pricing difference, and you pay for the expected growth in the public market. That is not a component over here. You buy the increase in value, but you don't have to add properties to this portfolio necessarily. This portfolio you do, or you get punished. And you will pay a fairly large fee, not because the people running the REIT make more, which they do, by the way, but so it's not a bad place to work. But there are all kinds of costs of being in a public company. There are a lot of regulatory costs and restriction costs that you have to undergo that restrict your behavior over here, and you have to pay those fees. So in buying a public REIT, you are buying a different package than if you buy property or buy private real estate. So that's my soapbox. And I think there are two different things. I do not diminish one in any way. And one other thing I'll show you between the two. These are the appreciation returns, or the change in value that have occurred over the last couple of years in the NAREIT index, which is publicly traded REITs, and the NACREIF index, which is private real estate funds. And if your vision is good enough, you can see that these blue columns look very different than the orange columns. Now, what the REIT world will tell you is that they are right and that the private world is wrong. And the reason they'll say that is because the private world is valued by appraisal and the REIT world is valued by transactions. But I would challenge anybody in the public market to go buy the entire company for the price of its collective shares. You can't do that, right? I think if you've studied finance, you'll know that if there's a bid to take a public company private, once you start buying the shares, the value of the mere fact you're doing that, the value of those shares will ramp up. That tells me that the value of controlling the company is greater than what I get by owning a share. Likewise, if you want to sell out of a publicly traded REIT, you will get a much lower value than what the individual share says. So I don't necessarily believe that the price of a share tells me the price of its underlying real estate. Now, there are a lot of people who look at that and study that. And frankly, I would encourage everybody to analyze that. I would love for you to prove me wrong. And I would learn something in the process. There's a lot to be learned there. But I think there's a big distinction between these two. I think they're both wrong and they're both right. But I do definitely believe they're different. And if you believe they're different, you might make different choices as you think about these things going forward. What oftentimes happens is people want the advantage of the private real estate performance when they look at how it is not correlated with their stock and bond portfolios. So they want real estate to improve their portfolio performance. And then they go out and buy publicly traded REITs thinking that they're getting real estate, but in reality, they're not getting the benefit that they would have gotten had they done it this way. So it's just a component that I have struggled with dealing with consultants and different participants in the market. I think these are very different things. Okay, I'll get off that soapbox and jump over. I see Professor Ling is not choosing to argue because that would take the rest of the call. We won't do it.
I'm tempted, but maybe another day.
Fair enough, fair enough. So I'll get off that topic and just point out that there are a lot of things people will tell you that they do to reduce risk that actually may increase the risk. So understanding the unintended consequences of things that are sold to you is very important. That's actually, I think, important in not just real estate, but across the board. And I'll give you one example of where I discovered this. Once I went to the publicly traded REIT, one of the things that REIT said that made them different than most other REITs was that they did not capitalize large expenses. So if you don't know this, I'll give you the 10-second background. Generally, when you invest in real estate, if you have a large expenditure, like you're going to replace all the roofs or an apartment, or you're going to change the elevator system or something like that, generally people will spend the money to do it. And then on their books, they will capitalize that and amortize it over time. They won't recognize the expense in the current period because that would make their income plummet. So it's very common that people would capitalize and do this. The firm I worked with did not do that. Anytime they replaced an elevator, they just expensed the whole thing in that period. If they replaced all the roofs in an apartment complex, they expensed it all in that period. And the claim that they made was that made them a lower risk firm than all of the other firms that weren't recognizing these expenses in the current period. At least that was the argument. And it stood up for a little while. until you realize that the unintended consequence here is they would not replace the elevator and they would not replace the roof, because that expenditure was so large, it would have a big impact. It has the same impact on their statement as anybody else's, but rather than capitalize it, they just avoided it. And then it turns out they depleted the value of the assets that they were managing. So try to understand the unintended consequences of what people might suggest. Okay, believe it or not, I'm actually going to pick up the pace because I see I'm virtually out of time. Everybody wants high risk. Everyone wants high returns and low risk. Either they'll tell you that directly, or everything they say will imply that. So every investor wants high returns and low risk. Nobody gets it. Nobody gets high returns with low risk. It really doesn't exist. So at all times, if something's generating a higher return, it's probably because you're taking greater risk. If something is generating a lower return, hopefully you're taking less risk by doing that. And both of those things are important. There are times when you want to take low risk and you'll accept a low return for it. And there are times when you're willing to accept higher risk because you believe you can get a higher expected return. And I'll come back to that one in a moment. Very quickly now, I'm going to jump from my experience in the publicly traded REIT over to SSR, which is a much bigger advisory firm than what MIG was. We did all property types. And in this case, I was not on the research and strategy team here. I took a job in what I think could be called business development. So I had client relationships that I worked with. And this brings me back to a charm I've already mentioned, which is know yourself. I thought that that role would work for me. And quite frankly, I learned that that wasn't a great position, because if you're in business development, your job is to sell what somebody else is doing. And I found that I have this major character flaw, and that is I have a hard time selling something I don't believe in. If I believe it, I think I can be quite compelling. But if I don't believe it, I just can't pitch it. And that was a challenge. There were many things I did believe and I thought were fine, but I happened to be at that firm at the time when they were making a big change. They were taking a very low risk fund, and they decided that they didn't like the performance, and they were converting it to a much higher risk fund. And of course, they were selling the higher returns, but it wasn't clear that that came with a lot more risk. And it turns out that that didn't work well. So again, be honest with yourself. Don't fool yourself into thinking, oh yes, I can do that, and so forth. So this sort of is related, and that is everybody has a personal motivation. We'll all talk sort of corporately about we're all motivated to enhance the client's experience. We all have the client's interest in mind, and we'll put ourselves at risk in order to help the client. And I think generally people have that overall feeling, but you have to keep in mind everybody has a personal motivation. And sometimes that fits with the overall mode, and sometimes it doesn't. So again, you can put this in the category of not everybody will point this out to you, but I think it's important to keep in mind that there are different motivations. And now this brings me to how you get hired and how you get promoted. And that is, you have to make yourself what the decision maker wants. I want to say needs here. I want to say you need to make yourself what they need, but I can't say that. You have to be what they want, because oftentimes what they want is not what they need. So you might look at somebody who's doing the hiring and say, wow, that person is a go-getter. They're a growth person. They're out there making new things happen. What they need is somebody who knows how to pull the reins back when they're getting too crazy or they're getting too far away, and somebody to help them stay within the bounds of what they should do. And that may be what they need, but they may not know it. And you have to be what they want. They may want somebody to come in and tell them they're doing the right thing all the time. And if you want that job, that is what you have to be. And so that brings me back to the same thing again and again, which is know yourself, decide what the person wants, and then decide if that works for you. And if they want something that fits with your personality and who you are, then you should really let them know that and help them make the decision to hire you. But if you really think it's a great job, but the person making the hiring decision or the person who you'll report to wants something that's different than what you are, then I would encourage you to wait for the next opportunity. There will be other opportunities. And that's a hard thing to believe when you're looking for a job or when you're striving for a promotion. You think, this is my one chance, I have to get it now. You'll be much happier if you wait a year and get a better opportunity than if you take it early and you're in a role you don't like. There's a pretty high cost to that. So you can get hired and you can get promoted if you know what they want and you make yourself that. I learned this by watching somebody get hired in a position that was much higher than mine. And when that person took the job, I'll just be perfectly honest, it made me question myself. I thought, I must be doing something wrong if that person, whom I don't think is very good, can do that role, which is much higher than my role. What am I doing wrong? Now, I had to pacify myself. I don't know if this is true or not, but I pacified myself by watching that over time, and I realized that person was a yes man. And he was hired into that role because the person doing the hiring had just put up with somebody who was a big fighter and had a lot of big ideas and would push back. And when that person left, the person hiring thought, I don't want that anymore. I want somebody who'll just agree with me. And that's kind of what this person became. And I thought, you know, in hindsight, that would not have worked for me. I would have clashed with that person the whole time. So I said that to pacify myself. It may not be true, but that's how I could live with myself not getting that kind of a role. I wasn't up for it, but I was really sort of frustrated as to how could that person advance so far given what I think they know. And a lot of times it's because they're very good at understanding what somebody wants and they morph to it. At some time I can give you a lot more details about that. But another sort of thing I would suggest is be skeptical of your own models. And we had a case with the SSR and BlackRock. It was sort of during the transition of those two times. I was there for a brief period, so I'll get off of this in a moment. But I'll just give you one point. We had a model that was a market forecasting model, and it was very fundamentally oriented. I was working with people who were absolutely brilliant, very, very smart people at doing this. And we had what I think was an exceptionally well-structured model. And the model at the time was telling us that the market was overvalued relative to these fundamentals that we were measuring. And therefore, our prediction, or what we told the market, was we expected very little appreciation in the coming year because we thought the market was highly valued. So we thought that inflation needed to sort of pass by and outdo the value growth, and we thought it would be very low. So we said 1%. The market did 5%. We were only off by 500%. Right? So the market was much higher than inflation. The market did extremely well. And then you have a problem because then when you do this for the next year, the market's even that much higher valued, that much farther away from your fundamentals. And so now what are you going to do? You're going to say, well, I think it's going to do even lower than the 1% last year. And I'm going to tell myself the market was wrong, my model was right. And I'm going to say it's going to do even worse. And so we basically said, we think the market's going to fall next year. And lo and behold, the market did another 4% on top of the 5% it did in the previous year. And at this point, everybody says, okay, clearly you don't know what you're talking about. And you have to go back to the drawing board. So I would suggest that you be very skeptical about the models that you form. They're there to guide you and lead you. They're important, but don't get too carried away with them. They're never perfect. And so I'm going to transition now again from this job where I was at SSR and BlackRock and move to UBS, which is a slightly different structure. This was a big advisory firm again, but in this case, we were owned by a global European bank. And one thing's important to know is where you fit in the picture, and that's why I put these things down here. UBS is a wealth management firm. They'll tell you they're a bank, but they're dominated by wealth management. So I believe at the time, and probably still, they were the biggest wealth manager in the world. And so that was the dominant component of UBS, and it drove everything that the company did. The exciting area and fun area is investment bank. And sometime in another setting, I will tell you what the word excitement means. It comes with two edges on that sword. But the investment bank was the exciting part. So there were times when it got a lot of attention. And then the boring, just sort of make money as you go along is asset management. And that's the business I was in. So when you're in asset management, you're working for big institutions, you're acquiring assets on their behalf, and you're earning fees. And that's a pretty steady as you go type of job. There can be various forms of it, but you have to know how you fit in the organization. So that was the one that I joined. And at some time, not today, but at some time, I'll tell you some of the really exciting moments I had when I was there. And I say exciting sort of conservatively here. So while I was there, I'm going to go back to the model sort of charm here if I can. And I'm just showing you a generic picture. This is Midtown New York. But at UBS, we had a property in Midtown New York where we had a ground lease. And several of these buildings sit on ground lease. So again, I'll give you the 10-second definition of a ground lease. And that is you have a situation where one party owns the land and another party leases that land and they build a building on top of the land. Now, as long as the lease is in place, one party owns the building and one party owns the land. And then when that lease terminates, then both go to the landowner, right? So if you own one of these big buildings, you can imagine that building is worth hundreds of millions of dollars. And when the lease expires, that building goes to the landholder. So it's kind of a tricky environment to work in. So by the way, as far as I know, the biggest land lease on earth is Hong Kong, or was Hong Kong, right? Hong Kong was leased from the Chinese by the British. The British turned that small island into the Asian mecca of finance and trade and retail, and made it the most highly concentrated wealth probably in the world. And in the 90s, I don't remember exactly which year, but in the 90s, that lease expired and everything there went back to China. Now, interestingly, that has led to all the conflict you see now in Hong Kong, because they basically went from being under British control, a colony of Britain, to now being back in China. And you can imagine they operated in a very capitalistic environment. And even though China is a lot more capitalistic than it was, it operates very differently. And now Hong Kong is struggling with that. But that all came about because of a land lease or a ground lease. So we owned a property here in Midtown New York. And my theory was that if you can ever put the building back together with the land, that your value should increase. Because when I do that, I'm eliminating risk out of that picture, right? If I have a building and a land separately, there's a risk between those two components. If I put them together, I reduce the risk and the value should go up. Well, we did that. We bought the ground underneath our building, and then we proceeded to lose money for 10 years. It was a pretty ugly outcome. It may or may not have to do with the fact that we bought that, but again, you have to question your models. I will always wonder about that. And in fact, I can tell you that in just the last couple of years, the firm reversed that position and resold the land underneath on the basis that the transaction team believed that by separating the land from the building, they could get more for the two parts than they could for the whole. Now, they might be right. And if they are, then I want to start a whole new business of buying the buildings and selling the land and selling the buildings separately. So if that's true, I need to look into it more. But I've certainly learned to question my model by that one experience. Okay, something else that we can pick up here. First of all, let me pause here. I think we're a little after 5. Are we okay, or should I just terminate right here?
No, you're good.
We're good. Okay.
We usually wrap up about 5:30.
Okay. I'll keep the pace, but I'm happy to be interrupted or ask a question. Let me just take the moment while I'm pausing here. Any questions, or shall I just plow on like people are wildly interested?
Yes, Bill, Sammy.
Yes.
The model in Hong Kong and China, do we have those types of situations here in the United States?
We don't have it to that level. but we have exactly that structure within the cities. So we had exactly that structure. Manhattan is probably the most concentrated area where that exists. And there are families that have been in the property business for generations. They've held the land and they've sold the building, or they sold the right to build a building. That's usually where these things happen, is that somebody will have a piece of land, a developer wants to build a building on that land because it's very unique or has a great location. And the landowner might say, I'm not willing to sell, but I will give you a 90-year lease and you can build your building and you can collect your revenues on there for 90 years, but I'm not willing to let the property out of my family. So that does exist, just not quite to the extreme level where we had a couple of islands that were leased that way. That was kind of a unique situation. As far as I know, I'm not aware of any other circumstance like that in the world.
Yeah, I was gonna ask, who did you buy the land from? Was it the church or was it just a family?
It was a family owner.
Okay.
Yeah. So in this case, it was, the family owned it. And when we originally bought the building on top of the land, they had no interest in selling the property. And part of what is unique about all of this, and I don't want to get caught in the weeds, because actually this is a fascinating project. I could have spent the entire time talking about this one project. But the fascinating thing here was it originally had a 90-year lease on it. And I think it had 20 or 30 years remaining when we bought it. And it was scheduled so that the lease payment was very, very low. But 5 or 10 years after we bought, there was going to be a big escalation in the lease payment. And so the thing that I believe has happened there is I believe that we personally, and also the valuers, undervalued the cost of the ground lease in that case. So that at a later date, when we valued what we thought it was going to cost us in the future and the likelihood of a zero residual, we put a high price on that. And quite honestly, I think we put the right price on the land, but we were not being penalized enough at the early stage. Now, all of my colleagues, I always like to be different than everybody else. All of my colleagues believe we paid too much for the land. But it turns out they turned around and sold the land for almost the same price we bought it for. So I'm not sure that we did. It's a fascinating story. Another date I'll get into some more details. So sort of similar to that last project, I think it's valuable if you realize that you cannot evaluate a project or an investment until it has gone round trip. You have to go all the way in. So you have to buy it, build it, operate it, lease it, and then sell it and realize the value at the end. At that point, you know the real performance of that investment. I can tell you there are many, many people. In fact, I'll tell you, even my own mother describes this. I can't even get her off of this topic. What they will say is, I bought that property. It did really well for 3 years. I did a great job on that investment. It did great for 3 years until all of a sudden it fell apart and I lost a ton of money. Well, that's part of the investment. That's included. So it's entirely possible you can buy a building. It might have above market rents. And therefore, when you buy the building, it looks like it's generating very high yields. And you might say, wow, this is great. I'm getting so much higher yield on this property than everybody else. I'm so much smarter than everybody else. And then when your lease comes to an end and you have to release at the market rate, all of a sudden your value drops. Well, you have to include that in your analysis and you have to include it in your evaluation of the performance. So let me give you another example that I had. This is a fascinating property. And I will tell you many of the things that we had in our portfolio that were just unbelievably good. Everybody would look at them and they'd say, boy, you need more investments like that. Those have probably gone through a really tough time at one point in time and just everybody forgets it, right? So this is a property. It's called Cambridgeside Galleria. So this is the property I'm referring to right here. And to put it into context, this is the Charles River in Boston. Boston property is over here off to the left. Harvard and MIT are located right here. So we're in Cambridge. And this is a 3-story mall with underground parking. Now, it looks quite packed in there at the moment, But in the late 80s and early 90s, this was a rail yard. And our firm, along with one of its best clients and a developer, got together in a joint venture and built this project. So after they built it, none of these other things were around here. The proximity seemed really good. The location seemed really good, but it was kind of an industrial rough area. And it just so happens it was hard to attract the high-end retailers there. So after spending hundreds of millions of dollars to build this, it was struggling. And so if you had been in the business of developing and constructing this building, and then you wanted to sell it, then you would have taken a beating. It was a tough investment early on. And I can tell you, many people at the firm, I wasn't there at the time, but I've talked to them. Many people at the firm were thinking, oh my gosh, I cannot believe we stepped into this quagmire. We've got one of our biggest clients in this. We're struggling. We have to put more money into it to keep it going. It's a very big challenge. Now, over time, and by the way, I will point out, the building, I think it opened in 1990, and 1990 to 1995 was one of the ugliest times in US real estate. You just look at returns, you'll find out there were negative returns from 90 to 95. So it was a really tough time to be in real estate. If you opened a new building like this in 90, it was a tough move. So people were very concerned at the time that we had gotten into a mess, and they were struggling with it, but we had a couple of benefits. One is we had big institutional backing, and therefore we had the ability to weather the storm. We had liquidity, and we had capital. We had the ability to put more money in to keep it going. And we had people who saw the future of this site and continued to believe in it. So over the later years, this all became cleaned up. The whole rest of the rail yard opened up. They built these office buildings. And now the street that you can't see here right to the right is a street where there's all kinds of tech incubator office buildings that rent for unbelievably high rates. And this whole component has now become a fabulous area. And so anybody who looks at this property today is jealous, and they would say, wow, that is a gem. You know, I wish I had gotten into that. What they don't know is that people were at their wits' end and wondering whether they should dump it before it got to that stage. So you have to look at the entire period of your investment. Now, interestingly enough, I said it was 3 stories. So this story up here, right around 5 or 6 years ago, retail went from being the highest performing sector to actually a weak performing sector. And so we had this entire 3rd floor leased out to very good tenants. I think, very good retail tenants were out there. And I believe the number, I won't get the exact number, but I believe our average rent there was about $35 a square foot. And we had leases that were going to come due over the next 2, 3, or 4 years. And the appraisers were looking at the leases that we had, some of the escalations that were in there, and overall the market. And they were saying, well, when you renew these leases, you'll probably get $40 a square foot. And they valued the property on that basis. And so as the value went up from 30 to 35 to 40, and this is true for all floors, but just the 3rd floor is the lowest rent of a mall, right? And so as that was happening, the value of the building was escalating and escalating. Our clients were getting big performance numbers because the value of their property was going up. We weren't liquidating it, but the value was going up, and they were getting all of this benefit. And then at some point, we started to look to release this space because we had a couple of leases coming due. And when that happens, you go to the market to try and lease it. Even though you'd like for the tenant to stay in place, you need to know, what could I get if I went out to the market? And we had an investment meeting on this, and the asset manager came in and said, well, our current leases are $35. The appraiser is valuing the 3rd floor at a $40 rent. And we believe it will be very hard for us to get $10 a foot. Now, I can tell you that's a very interesting investment meeting. So they're now telling us that they believe that they're going to have a hard time getting 25% of where the appraisers have valued this property. Not the whole property, but just the 3rd floor. And so then you start thinking, well, oh my gosh, are we going to have to turn around and tell our clients that we just lost 75% of the value of this floor? And it turns out there was an alternative. So as those leases started to come due, so this was, we started bad, it became good, not just good, it became great. And then all of a sudden we had this realization and it became bad again because we thought this impact on the third floor is actually going to cause us to write down the value of the entire property by a material amount. Tens of millions of dollars would have been the loss there. And even though we wouldn't have lost money, we would have lost, the value had gone up and then the value would come back down some, and you just don't want to take those blows. So the result was we ended up not leasing this to retail tenants. Instead, we converted the space to what is shown down here. This is actually a virtual image of what they're doing. It's complete now. But we opened it up into a very open office kind of location that, as I mentioned, the office space is renting at very high rents. And so it turns out that we really were able to get back to that value, but we had to go through this transition. So there was risk involved in us doing this. Nobody really talks about the risk. There was risk, but the outcome was quite good. We got back to a state where this is a really great project. And then I'll just throw in the little sideline. Before we even started fitting this out, we were just clearing it and clearing the space. WeWork was interested in renting the entire space. And so we had people running around the office saying, oh, we're going to have a big WeWork lease. This is fantastic. Some of us weren't that excited about it, but other people were beside themselves. Fortunately for us, WeWork went bust before that lease was signed, and we didn't have to deal with it. They were able to lease it to others. So anyway, this project has gone from bad to good to bad to good. If they execute on it and keep it going, then the result will be, the total result will be fantastic. But had we made different decisions along the way, we could have had a really disastrous outcome.
Mr. Hughes, can I ask you
Yes,
a question?
please, please.
So, you guys talked about third floor and, renting it out as far as leases to retail. With properties as far as retail and that going on the decline with online shopping and,
Right.
the online services, do you think places like this would survive 30 to 40 years from now?
That not only is that a great question, that's a great question that a lot of people are asking. And I don't know that very many people have an answer, but I can give you my opinion. I don't have any data for this yet, but I believe that we're going to see a separation of these properties. There will be many properties that will be like this one, and it will have the opportunity to convert to something else, and it will maintain its value, and it will operate in a slightly different structure than in the past. And I can tell you, every mall owner right now, and most of the malls are owned by public REITs, but every mall owner right now is thinking about that. What can we convert this to, and what can we do with it to keep the value up, because we think the retail values are going to fall. And some properties will do that very smoothly. In fact, they might even do much better, and they might not have thought about doing the conversion, but now it's led to this. In fact, I can point out here, not only did we do this conversion, but now the firm is in the process of, on this space back here, they're planning on taking out a huge tenant, knocking the space down and building an office and multifamily tower above. So they're basically doing this, they're doubling up on it. And so there will be that opportunity. There will be a whole bunch of malls where that won't work. They won't be in the right location. They won't have the right structure, and there just won't be anything good to go in there. So all of a sudden you're going to start seeing things like, laser tag taking in the whole third floor, and they're going to be paying 12 cents a foot to get that space. It's going to be disastrous. And there are going to be another set of malls, which quite frankly never should have been built to begin with, but retail is really hot, and those malls will go dark. They will shut down and become a zombie mall. So I think the answer is, it depends. That's usually the answer. The key is going to be trying to figure out which ones have this opportunity, which ones don't, what's the right step to take. So quite frankly, even though a lot of people will say retail is a bad place and they're worried about it and so forth, I think retail is the most fascinating place right now. It always changes format. This is not really new. It's just a really big time. And I like to point out to people that everybody puts retail down right now. But from 2012 to 2016, retail was the top performing sector. It had the fastest growth. And in fact, that was driven by malls. So the world changes very quickly. We just have to be able to adapt, and retail changes more than most. Thank you for asking that question. That was great. Something that I think is turned on its head from what you learn in class is this particular phrase, and that is, in class, I believe you will learn that investors require higher returns in order to take on greater risk. And I believe that is a fundamental economic concept. Remember at the beginning, I said that when we compare to gambling, investing is risk averse, and therefore you have to be paid to take more risk. I think you're going to get that message throughout your coursework. And I firmly believe that. That is a good description. The challenge is that when you move into the professional world, people will take that statement and reverse it. And then they will say, I need higher returns, so I'm going to do something that's riskier. And that doesn't necessarily hold true. By definition, when you take greater risk, you might be moving up the expected return, but you are also increasing the probability of a negative return or a lower return. Those come hand in hand. And so one has to be very careful to not assume that higher risk yields higher returns. Sometimes higher risk is just a bad decision. And if you don't recognize that, you're likely to make some bad decisions. And in fact, I would argue that the pension fund industry has repeatedly believed this and made this bad decision over and over. And so I can't tell you how many times I've heard from a pension fund manager who should be among the most conservative groups out there. And they will say, well, our actuarial rate is 7% and real estate's only providing 5%. So I need to do something a little more aggressive. And I want to say a little more aggressive just increases the probability that you won't get the 5%. It might give you a higher number, but if you're underfunded now, you're likely to become even more underfunded later, particularly if you do this as an absolute definition, right? I might get away with it one time, but if I do it over and over and over, it will cost me. And the vast majority of defined benefit pension funds in the US are underfunded. They cannot currently fund all of their payout obligations. So higher risk does not produce higher returns. Of the charms you pick up and put on your bracelet, I'd recommend this one. If you understand it, it will be valuable to you, particularly if you go into the consulting business. It's a critical thing to know. Now the next thing I'm going to say, I'm going to show you my favorite quote ever, my favorite investment quote I ever had. Before I put it on the screen, I want to give you just a brief background because I find the circumstances very unique. I happened to learn the most interesting quote when I was in Riyadh, Saudi Arabia, of all places. I've been there one time. I met with a handful of clients, and with one of the prospects that I was meeting, he was making this same point to me. He was basically saying, look, your returns are kind of below what we're looking for and so forth. And I was, of course, in my normal mode and saying, I believe this is where core real estate, low risk, stabilized assets, I believe this is where we're headed. And it would be very easy for me to tell you a higher number, but that would be inappropriate. I have to tell you where I really believe the core returns are going. And I don't think they're going to generate 7% going forward. And this was about 3 or 4 years ago. And I said, I just don't think they're going to go there. And it would be inappropriate if I said they were. And he kind of sat back and he said, you know, it's funny that you mentioned that because about a year ago, we had this other economist in. Now, I don't remember who it was. So unfortunately, I can't attribute the quote, but it's not my quote. It's somebody else's. And it's the best quote I've ever heard. And he was telling this particular economist, I actually believe it was a Nobel laureate, and I'm disappointed I can't ask him who it was. But, and by the way, in the Middle East, you get these really brilliant people coming in and talking to us. It's a fascinating place, but nevertheless, this Nobel laureate economist is talking to him, and he was saying something, but he just did it in a way that was really impactful. And you have to put this into context. When you're talking to a prospect that could mean millions of dollars for your firm, you know, the marketing people you're with just lose their mind. They want you to say everything to get the deal done and so forth. And they bring in these research people who kind of just say what they believe, and it scares them to death. So I'm always thinking about that one of these meetings. So this guy basically says, look, from this investment, we need a 7% return. And the economist responded by saying, the market doesn't care what you need. Now that's the best answer I've ever heard. I mean, it's really to the point, and it's so true, and it's so fitting for all of these meetings, hundreds and hundreds of meetings that I've had with investors who've basically said, well, I need this return, or I need that. And my response to them is, well, you're going to have to be more aggressive. You're going to have to take the risk of losing more, or you're going to have to do something else. It's just, you don't just get to pick what you need in the market. And I don't think I ever said it this well, but this is my favorite investment quote that I've ever heard. It was brilliant, and I will forever remember it, and I will constantly repeat it. And if you keep in your mind, the market doesn't care what you need, then you will learn that we are all price takers. The market sets the price. We can decide whether we accept it or not accept it, but we don't get to change it. So very important, very important. Okay, and I am wrapping up to the end here. I promise. I do apologize for keeping you so long, but I think one of the last few pieces here is people always tell you about the winners, and I can tell you about a lot of them. I've had a lot of deals that I look back and I think, man, that was so fun. That was really great. Our clients made a ton of money. I enjoyed being part of it. And I worked with a firm that at one point made a huge, really great performance, and it was a lot of fun. But nobody really tells you about the losers. They always tell you, oh, we made 30% on this deal and we made 25% on that deal. And usually if that happens, it's because something was mispriced and you took a lot of risk. But it's great when it works out, and those are fun. So again, I'm going to do what nobody else does. And I'm going to tell you the worst project I've ever been involved with. And I know this is a really ugly slide, but it just helps me walk through because I might tear up a little bit when I think about this one. So in 2013, we bought this property, and I apologize. I really can't tell you the name because I no longer have the rights to be so honest. But we bought a property, and this is pretty much what it went like. This is pretty much the result. I'm going to tell you the price was $163 million. Now, a little side piece, we did this in partnership with somebody else, so we had half of this. But the project overall had $163 million at the time we purchased. It had $80 million in debt, and so our loan to value was about 49%. Now, I will tell you that's very high for the fund that we bought this into because our fund was a very conservative fund. But it has high and low valued or levered properties. So this was perfectly reasonable, but it's higher than the average. And at the time we bought it, or the year after, the NOI on the property was $7.2 million. Now, if I just mechanically take that 7.2 million, this is a little unfair because this is actual. So this is what we actually earned. This is the price we paid. And if I take that, that means that our real cap rate was about 4.4%. And this occurred at a time when the 10-year treasury yield was about 3%. So our initial yield was about 140 basis points over the 10-year treasury. I'm going to tell you, for what we were buying and what this was, that was an expensive price, but it wasn't completely unreasonable. It was definitely a high price. I need some water because I'm like choking up on this. In 2016, everybody felt pretty good about themselves because we bought this great building. And by the way, I will tell you, this was a brochure building. This went on everything we did. Most meetings we went to, we would somehow drop in, oh, by the way, our fund holds that property, and so forth. It was a really brochure quality kind of asset. Well, in 2016, everybody is, it's not blowing the doors off, but everybody's feeling pretty good because our NOI, we've done a couple of leases. Our NOI has gone up by $600,000 a year. We're at $7.8 million. And that means the implied cap rate on our original price here went to 4.8%. That's starting to look a little bit better. I will tell you, at the time, the appraisers kept the yield down and the property was appreciating. So from 2014 through 2016, we were gaining value and earning more income. Everybody's kind of patting themselves on the back and feeling good. But remember what I told you earlier, you got to look at the total picture. So last year, the property generated $5.6 million in NOI. And the appraisers changed the cap rate to 6.8%. And that means the value of the property was $82 million. That's not a good number. At the time, the debt had been paid down from 80 million to 73 million. So we had a loan to value ratio of 88% last year. The 10-year treasury was down, so that was to our benefit. The 10-year treasury was down to about 2.1%. So you might notice here, our original cap rate was in the 4s and the appraisers were writing it up. Now the cap rate is in the high 6s and the 10-year treasury is down. So at this point, I would usually ask you a question and then I would wait because nobody would answer it, but I'm just blow it out here and say that what has happened is, and this is the way it usually goes although nobody underwrites it this way, when you lose income, your risk goes up and your cap rate rises. So these do not happen independently of each other. They happen in concert. And when they happen together, the loss of income causes your value to fall, and the rise in the discount rate causes your value to fall, and your value falls twice as hard. So you get a compound negative effect. Nobody underwrites it that way, but that's usually the way it works. It's very rare that your income drops, but your cap rate goes down and it's all okay. Sometimes that happens, but when things go bad, this is the way they go. And now we have a property that's worth just a little more than the debt. And by the way, we have loans coming due. We have a major tenant up for renewal. I can tell you in hindsight now, that tenant did not sign the renewal and started holding out and arguing for much lower rent. I don't know the result, but I know that did happen. And our partner wants $32 million in improvements to go in and invest in the property and make it better and rejuvenate it and so forth. The bottom line is this year that our firm handed the keys to the partner and walked away. So that means that the investment in this very large asset went to zero. Now there was some income earned along the way, so it wasn't like 100% loss, but this is what you would call a bad project. And very few people will tell you that it can go this bad, but it can. It can get very, very ugly. It goes the other way most of the time. Most of the time, you're surprised on the upside, things go well, you develop a property, you underwrite it at a 20% return, and lo and behold, you got a 30 and life is great. But on occasion, they happen this way and they're pretty ugly. And I take personal responsibility. I was on the investment committee when we bought this. And I will tell you just a little lesson, and that was I allowed notoriety to be a substitute for quality. I knew that there were issues with the structure, but this was such a well-known property in such a remarkable location that I allowed people to convince me that this was a really top-notch asset. And it turns out, no, it was just a common asset in a great place. And when retail got hit, which is what this is, it took a big blow. So it can go bad. It is possible. I also want to leave you with this, and that is enjoy the good times. They won't last. But I can't leave you with that statement. That would really be nasty of me. And I don't really believe that it's bad. I do believe they'll come back. So I'm not a big believer in cycles. People spend a lot of time talking about cycles. I've never been a believer in cycles. Part of that's the engineer in me. I believe cycles should have a frequency and an amplitude. And I can predict the future, and I can't do that in the business cycle. So, but I will tell you, times go up and times go down. And how you're positioned will dictate how you perform during those different times. And it's very common that people will get excited in the good times, and then they will double down on what they had, and then they face a bad time. That happens more times than I can describe. So enjoy them, be careful. If the times are great, that's a good time to take risk off the table, and recognize that after there's a turn, it's not a cycle. I can't tell you when, but they will come back. Real estate has had bad times, good times, bad times, good times. It happens over and over and over. There are enough good times in this business to far outweigh the bad times, as long as you're not grossly over levered and have no liquidity. If you avoid those two things, you will be there for the good times over and over. And it's a great industry. So I apologize for us not being in person. I would have been more interactive if we had been, but I've finished what I have, and I'd be happy to hang around if you have any questions. I've gone over my time, so if not, please feel free to bail out. Thanks a lot. I appreciate the time.
Well, we're a
Thanks
little
so
bit
much.
over time, but anybody have a question?
Yes, Dr. Hughes, real quick, in terms of some of the effects that derailed the income producing on the project that you did, can you just give us a couple of the factors that impacted the income of that property?
Yes. So a little more detail there. It was a retail property. It was a multi-story retail property, and everybody will tell you, as you go up, the value of the retail declines pretty rapidly. And we obviously knew that. So that was a component, but we bought at the peak of the market. I mentioned 2013 or 2012 to 2016 was a really high time. We wanted to be in a property that was like that, and we allowed that to sway our decision. And so we bought right when the leases had peaked, and we had a really big tenant that made up about 45% of the property. And the other leases were very high priced because there was limited space. But once there was a crack in that and space started opening up, then like most projects, it just starts to tumble down the waterfall. And so one bad turn leads to another, and the next thing you know, you've had a huge drop. And then that drop leads to higher risk, and your pricing goes down or up, depending on your way you look at it. Your yield goes up, which forces your price down even more. So we lost a fair amount of income, and there was a lot of risk also associated in re-signing that tenant. Thanks for the question. I appreciate you guys staying in with me, and I do appreciate the few questions I let you edge in there. That's great.
Well, Dr. Hughes, I wish next time we could get you to be a little more honest about your opinions. You just held back too much.
Yeah, I apologize.
Yeah.
No, I finished apologizing. I did that on the first page.
Yeah, that's right. You said
No
you were going to
apologies.
apologize.
No apologies.
All right. Well, we're running a little bit over. We should probably stop it there. And thank you very much for joining us. And students, I think you can see you've got a great resource up in the center, in addition to Mr. Becker and Ms. Wagner, of course. All right.
Great.
Goodbye, everybody. Take care.
Thanks, everybody.
Thank
Thank
you.
you.
Thank you.
Thank you.
Good job, Bill.
All right.